In today's class, we'll learn about cash flow and taxes, which is chapter 9, and we'll be learning about the importance of cash flow management, how to describe the working capital cycle. Also, we learn about the cash flow statement, analyze receivable for cash management. Also, we'll be looking into accounts payable management to manage cash. Define capital budgeting, calculate the time value of money, and how to plan and manage for taxes. Okay, when we say cash, cash is the blood of, like, just like the human being. The blood, if there's no blood in our system, we will not be able to exist. We will not be able to take in energy, which is oxygen we need, and we will not be able to survive. So also for cash, cash is very important for business. Cash is actually the energy that keeps a business going, that sustains a business, that makes business carry out its operations. If there is no cash, it's very challenging for the business to operate and sustain itself. So when we say cash, actually we do not just mean that the business is making profit, because yes, there could be that a business is making profit, but the business does not have cash at hand. When we say cash at hand, we are actually talking about the money which a business must have at every point in time to run and manage itself. Without cash on hand, the you will not be able to pay essential expenses such as salaries, such as rent, such as little expenses, such as buying materials and every other expenses that comes with running and managing the business. So it's always very essential for a business to have its cash at hand, even though um, the business is saying it has profit or it does not have profit. That does not matter, because sometimes our income statement says we are earning a profit, and it, if the income statement says we are earning a profit and still we do not have the cash at hand, the business will face a lot of challenges. That means the business will not be able to pay all its essential expenses. But even if a business is earning a profit, or the business is running at a loss, cash at hand is a very, very important aspect of a business, and because the cash is the energy, the life wire that keeps the business running. So this brings us to this class. We're going to learn and talk about how to manage our we're going to learn about how to manage our cash flow and taxes. So, like I said, the success of a business depends on the cash from startup through its entire existence, and managing cash is more critical than managing sales, because sales without cash receipts are a recipe for disaster. I mean, even though a business is making profit and there is no cash at hand to run the business is going to fold up. So we're going to look at income statement. Income statement does not show the cash flow. It does not show the cash flow. I mean, cash flow is the inflow and outflow of money of the business, but the income statement does not show this at all. Actually, the cash flow statement, the business is supposed to have a cash flow statement, that is a financial report that shows the money is coming into and going out of an organization. So the when a business has a cash flow statement, then the business will be able to be managed well, and you would tell if the cash flow is negative or positive. When we say there's a negative cash flow, it means there's no enough cash at hand to meet with the business with the expenses such as salaries and rent. And if we say it's positive, means there's enough money, cash flow to run the business, to keep the business operating. So this is, like I said earlier, the income statement does not show available cash. So this tells us that cash and profit are not the same, because the income statement tells us that it tells us if the business is making profit or it's not making any profit. Whatever the case, it does not show the cash flow statement. It's not the cash flow statement. The cash flow statement is totally different. It is a different financial report. So it's the cash flow statement is also a very important, like it's also very important. This shows the inflow and outflow, the daily activities of the business as money comes in and as money goes out, because the cash flow statement records not just the inflow and outflow of the business. You will be able to know what you are expecting and know how to spend. When you have the cash flow statement, you are able to manage the cash flow finances better. Now, what are the rules to keep a cash flow? Because if a cash flow is not well kept, they will face you there's likely tendency that you're going to have an insufficient cash available to run the business. So these are the rules which one must observe. One is that you should avoid buying inventory you do not need. Inventory means stocks. When we say inventory, there are lists of items such as property, goods, um, goods in stock, or the content of a building, okay, and that are valuable, that can easily be converted into cash, or uh, probably mean you can easily used, okay, used for the business production purposes. So we should, when we want to have a good, to avoid getting caught with insufficient cash flow, we should avoid buying inventory we do not need, like for example stocks or property that we do not need, machineries we should not buy them. So because when we buy these things we do not need, by the time we need money to buy those things we need for the business purpose, we probably not have the money to do that. The another thing is to collect cash as soon as possible. When your debtors reach out and they offer to make payments, you should never postpone that opportunity. You should try as much as possible to collect it as soon as possible. Also, there are some debtors that are not willing to reach out to you. You as the business owner or the person in charge of such department should reach out to them, like what some businesses do. They send you reminder, right? They send you reminder, but all of this should be done in a polite way, because if you don't do this, you could either lose the money or the customer. So this is number one in your slide, that we should collect cash as soon as possible. Never ever downplay or play negligence to opportunity got it to collect your cash as soon as possible. I mean, you should uh, try to avoid postponed payment, okay. I mean, for the goods or services rendered, once it's you rendering it or you giving out your goods, you should ensure to collect money. But at the same time, there are people which can collect goods just the way we have creditors to pay, collect goods to use and pay at a later date. We should also give, as business to also grow and be successful, we also give such other people which are our customers such privileges, like telling them to collect goods and pay at a later date. It's a good way of running a business. At the same time, it's not good if you cannot follow up on your debtors, and if you cannot ensure or make sure they pay their debts. So in making that possible, it's that you should reach out to them to remind them in a polite way, and at the same time you should also try as much as possible to go collect when they offer to make the payment. Okay, so we should also pay your bills by the due date, not earlier. I mean, when your bills are due, you should pay, not paying earlier. This does not actually favors the business. When bills are not due, you start making payment, because sometimes when we make payment for bills that are not due, by the time it's time to make payment for other bills that are due, the cash will not be available. So bills like electricity, rent, salary, and other kind of expenses that comes with the type of business that is done should be paid when as at when due. Then they should always check the availability of cash daily. You should check the availability of cash daily. I mean, how much are you expecting? You should give estimate. Over time, as a business is being carried out, you'll be able to tell the amount you have at hand at a point in time. So also you should be able to estimate how much the limit at which you can spend your business money at every point in time. So as a business owner or as a manager, you should try to strike a business between your income and the cash inflow and your cash outflow. Usually it's always better and to be on the safer side, to ensure that your cash inflow is greater than your cash outflow. Then another rule is that plan ahead for seasonal or contractual needs by seeking financing early. When you know there's going to be something, a business thing to do that will that will and with that you will be needing more money, you should ensure that you try to make preparation that ensure the money is available, okay, before the time for the payment is has reached. You have to ensure the money is available, and you should also try to seek financing early. Sometimes it could be the project or whatever we intend to do, the cash on hand or the cash we are expecting might not be enough. So in order to avoid insufficient cash and stopped in operation, we should ensure to check find other means at which these projects can be financed. Then another the last rule is you should lease or finance instead of buying equipment where practical. Sometimes we don't have to buy all the machineries, equipments we using, or the buildings. It doesn't mean it must be a building owned by you or bought by you. You could actually rent, you could lease, and all of this you can actually use, and this helps to strike a balance between your cash flow, inflow and outflow. So moving to the next slide, we also have what they call non-cash expenses. Non-cash expenses has to do with depreciation. Over time, these machineries we use or buildings, they lose their value, and this value must be reflected in the income statement. Though means you deduct the a certain amount away from the total value of that asset. For example, if the asset was like 50 million, like 5 years ago, over the years, if you deduct like 5 million, and it could presently, maybe after like 5 years period, it could only be 45 million. So when you depreciate an asset, you are actually deducting a portion of its cost from your income statement. So although the cash is not something physical you can touch and or have access to, but definitely the item, the machinery or equipment or house as the case may be, is depreciating in value. Surely it's not as efficient the way it used to be, or probably at that point in time the market value is not what it used to be. So there has to be adjustment to asset value, not evolving cash when we talk about depreciation. So these are also called non-cash expenses and can distort the financial picture of a company. So we also have the working capital cycle. Working capital tells you how much cash the company will have if it's paid all its short-term debt with the cash it has on hand. And it's the formula is current asset minus current liabilities. Means the value of what you have and the minus the value of what you own. So if we a company with positive working capital, we always outperform a company with a negative working capital, because a company with a positive working capital will have a lot of cash at hand to carry out its operation, to meet with its expenses, and also to pay for its debt. Or like a company that does not have a positive working capital. Now moving on, we're going to look at this cyclical and seasonal nature of cash flow. And the professional need a cash flow statement to determine its cash position of the business at a specific point in time. These are one of the additions. And cash flows, it's like a continuous process. It's like a cycle. Okay, it's like a cycle, and it's kind of relative to specific transactions. It can be seasonal for some business anyway, and some business it's not seasonal. This depends on the type of business operation you're doing. So the amount of cash flowing into a business may depend on where the business is at a particular point in its fiscal year. So if you look at this, you could see that okay, if you look at the purple is the cash inflow, the peach is the cash outflow. Then we have brown, which is the production and delivery. This is not clear enough. I will just use this the next slide. For this is a cash flow cycle for a manufacturer. So let's use the example for a cash flow cycle for a residential cleaning company. So the production and delivery summary is the orange. This has three colors, same process, because it's just a continuous, it's a cycle. It's a cycle. Like almost everything in the world, we have cycle. Like the animals, the human beings, the insects. Okay, we all have our own cycle. We have every phase. Okay, we have a cycle. It's a process for everyone. Okay, now let's look at this, the cash flow cycle for a residential cleaning company. You see the purple payments are received. If you look at the purple boxes, it's payment received, payment deposited into account, funds available. These are way in which cash are coming into the business, okay, the residential cleaning company. Then if you look at the yellow boxes, they are actually how the cash also leave the business. Okay, they cash before delivery paid, or cash on delivery paid, their operating expenses paid. This is how they spend their money. You see, look at the arrow, these cash are going out. If you look at the arrow, they are going out. They are going out of the business. They are not going out of the business. If you look at this, you see these are the arrows. They are going out of the business. And if you look at this one, they are coming into the business. They are coming into the business. So but the business as a whole has this is a cycle. It's a continuous period, year in year out. They supply, purchase and received, they do customer order received, they clean service provided to the customer's home. The cycle repeats itself. It's even stated there, this cycle repeats itself continuously. I mean, these are the operating process. Okay, and this is how in this operating process, as it comes like this, go like this, their money is coming in, and money is also going out. Okay, now using a cash flow statement, knowing how to read a cash flow statement is a very, very important skill for any business person. It's very, very important. So the first function of a cash flow statement is to record all sources of income. We must ensure that all these sources whether big or small, in which money comes into the business is recorded. Then you should also try to break down inflows and outflows according to whether they are related to operations, investing, or financing, because inflows could be coming from the operations. Then outflows could also be coming, um, cash flows or outflows could also be coming in or going out from investing. Investing means you've invested, right? Now means you've that is a for cash outflow. Inflow means you've earned, the money is coming into the business. Then for financing too, buying financing means you buying what do you call it, machineries, equipments. You finance bigger projects for production purposes. So a cash flow statement must break down and must be very distinct in analyzing or showing this in the record. So when these are well recorded and shown in the records, the cash flows, the inflows, this gives a clear picture of the cash position of that business, of that company. Now we're going to look at the formula for cash flow. We say when we say cash flow, it actually means uh, not just the money at hand. We could also make apart from the money at hand, we also have what they call cash receipts. Okay, these two together. I remember you've actually done set in your higher school. So these two put together actually gives you the bulk of your cash inflow. Okay, this gives you your cash inflow. Then minus your disbursement, and this gives you your cash outflow. Okay, your cash outflow. So when you minus your cash outflow away from, which is the cash disbursement, away from your cash inflow, you get your cash you get your cash at hand. The working, what you have. Okay, it means the cash flow is divided into three categories: your cash at hand, your cash receipt, minus disbursement. This one will always be at your hand, but this one you must always pay out. Disbursement means, just imagine, if you're not paying salaries, if you're not paying your rent, if you're not paying your bills, of course the business will fold up. Your workers will not come to work, your electricity will be disconnected, your telephone bills will be disconnected. So all the disbursements must always come when you come to running of your business. Okay, like the example I already showed you before, all this is a continuous process. Cycle, it's a continuous process. Okay, now moving on, we're going to look at operations. Okay, these are just definitions you can actually check on your operations: money used to run the business, investment, money going to equity, and money into and out of investment. All these are equity. Okay, into actually means money going to actually considered as equity, such as equipment, vehicle, or real estate. Then we have financing, debt used to finance the business. Now let's look at the cash budget. First of all, there are two steps to forecasting cash flow receipts. The one is that the project cash receipts from all possible sources should be recorded, should be taken down, should be noted down. Okay, but not others that have not been people make order but they've not make payment. All of those ones and others are not cash receipts. They should not be considered as cash receipt because they may not become cash. It's 50-50. It could be that customer has made order, and as far as that customer has not made payment, there's high tendency that transaction might not hold, because you can say transaction has hold if you offer and the customer has made payment. But for those orders that the customer has not made payment, you cannot consider there as a cash receipt. Then there's also step 2. You have to surprise procedure that will need to be dotted to meet this level of cash receipt. Like cash expenditure are only those expenses and probably you actually have to pay during the projected time period. Now let's, how do we now, after all I've said, explain what is the importance of cash, what we use cash to do, income statement, profits, the difference between profit and cash flow. Then I've also explained what is positive cash flow and negative cash flow. I've also mentioned about inventory, and also about what do you call it, the what did I mention? Mentioned about the cash flow equation. I've also mentioned this cyclical and seasonal nature of the cash flow, and I've mentioned all of this. Now let's look at how to create a healthy cash flow. We also looked at the rules too. I mean, the rules so that you can strike a balance between your cash inflow and cash outflow in running your business operation. Now let's look at creating a healthy cash flow. For healthy cash flow management means keeping sufficient cash on hand and available to pay your bills in a timely fashion, and in general to have financial resources available to you when you need them. Means that the money, there should be money available, okay, as at when, summarily, it should be available as at when you need them, okay. That is the foremost, is very important. The most as entrepreneurs struggle at various times to have sufficient cash to pay for materials, rent, and other expenses. So if you because you know, if your cash flow is not well managed, you will you the as an entrepreneur you suffer a lot to meet with your your expenses. Yes, because you've actually given out your product and services out, especially when you sell to people that are indebted to you, and you've not collected the cash. It means you just gave out your goods out, and the money is not there to kind of to run the business. So as a business becomes more stable and successful, deciding when and where to invest excess cash to manage earnings at the appropriate risk level will be an important part of managing the company. So you should always ensure to know when to and when not to give out your products for on credit. Yeah, I mean, because you want to make sales, you just give out on credit, and at the end, when the business folds up, it's not running. It's the customers will definitely go to other businesses to patronize. So you should ensure you strike a balance, okay, and making sure that there's sufficient cash on hand and available to pay your bills in a timely fashion, and in general to have financial resources available to you when you need them. So we're going to look at about how to ensure this. Is what they call the aging schedule, okay. But before that, let's look at managing inventory to manage cash. So how do we manage our inventory? Like I told you, inventories are a list of items such as property, goods, stocks, okay. Now your inventory could be stock, those stocks you have, products you have, you've produced, you've manufactured, but you are yet to sell, but they are there. It's something you can easily convert or turn into money. Like for example, you producing noodles, okay. Noodles, there are different brands of noodles, okay, and now you have lots of cartons of these noodles, or you buy and sell. You've actually spent money in acquiring this, whether through production purpose or by buying, and after collecting all of this, you are yet to sell to your customers. If you leave that thing down there, there are stocks that you can easily convert to money. All you just need is for someone to come and show interest that they want to buy. So let's say, for example, you have this inventory. How do you manage this inventory to manage your cash? Because they are also considered as asset. I mean, they are considered as a asset that you can easily convert to cash. They are considered as cash, let's put it that way. The difference is that they are not yet raw money you could actually use to buy, but it's something you can easily convert to money, I mean cash, and use for your business. So inventory is often one of the larger components of a company's asset. It's very big. They are usually very big, especially those big production companies, manufacturers. They have lots of inventory. Apart from this inventory I've mentioned, the example of people like the noodles, don't forget there are other inventories too. So for example purpose, I'm only using this as an example. So to controlling this your inventory is very critical steps in managing company cash flow, because if you have lots of inventory and yet there is no money, I mean you can't actually use your inventory to pay your workers, can you? No, because there are products, for example like the product I gave you an example, the cartons of noodles. When it's time to pay your workers, you want to pay them their salary, will you give them cartons of noodles and say take home? No. This because you have to supposed to pay your workers with salary, with cash. You're supposed to pay your rent. For example, the building was rented, you're supposed to pay with cash. You're supposed to pay your power supply with cash. So that is why your inventory must be managed well to get your cash, to have your cash at hand. So if not controlling your inventory well, is going to be in a very the you're going to be a very tight situation. Okay, so inventory is very is a critical step in managing a company cash flow. So if you buy inventory, you run the risk that no one will buy it at a price that will give you a profit, or even buy it at all. So this is why we have to be careful, because if you have inventory, for example, I was using a carton of noodles as an example. After spending so much to buy this carton of noodles, unfortunately for you, you could not sell at the price, at the cost price. Okay, and what does that turns into? It means you sell it there at a loss. So this is why we must this is another reason why we must ensure to manage our inventory to manage cash. Because if you sell less than how much you bought all of this, you're going to lose your money, you're going to lose your cash. So there are two risks involved with inventory: storage costs, because you're also going to store, you are going to store it, and sometimes this storage is not cheap, it's not free. There are also costs of running it. If there's things that will be bad, maybe for example things that needs to be refrigerated, you must think of how to run, pay for all the logistics that comes with refrigerating them. Okay, or you must also look at probably the packaging too, the warehousing and everything. All of this come into play when you want to store your inventory. Okay, like I was giving you an example of inventory of cartons of noodles, right? You need space, right? To put all of this, you're going to pay for everything. Sometimes this is why you see some companies, they have their warehouse different from their operations center. They kind of look for warehouse or at other centers or places close to their company. Then we also have privilege. Privilege is actually theft of inventory. This is very common when you keep things, and if it's not well managed, your inventory is not well, you get some workers or probably internal theft of the inventory. You experience that, or external. This external means people coming, people that are not part of the company, they come around to steal them. Or sometimes could be even be internal, the staff, they find way or the other to maneuver this inventory, the records or the numbers, or as the case may be, in whatever way they feel they can steal all of this, they do. So this is why we must be very careful how we manage our inventory. Inventory is even a very core part of your is a very core part of your cash flow. So if there's negligence about it, the business will definitely suffer its cash flow. Now moving on, we're going to look at how do we get more cash. Okay, so one thing is that you have to free up cash by reducing your inventory. It means you have to get more cash, you have to reduce your inventory. It's when you reduce your inventory, it releases cash. That means you're selling, right? As you are reducing the inventory means you're selling, that is, you'll be getting more cash. So, but however, it's not all the time, most times easy to reduce your inventory. There could be challenges here and there in doing that. Sometimes even before you reduce, the goods are spoiled, or they're out of market, or there's change in style, taste. So sometimes these there could be challenges here and there that could give you this uh, um, that could not actually help to generate that will, that will pose a kind of challenges for you to release this to reduce this inventory. So inventory has to be well managed to ensure that before all these I have mentioned, all of these challenges I have mentioned, before they come into play, you've already started releasing them to get your cash. If inventory is in the form of work in progress or semi-finished goods, additional materials and labor costs may have to be invested to make it ready to sell. Okay, because sometimes not all inventories are finished goods, some are still work in progress, and some can be semi-finished goods. So if you want to actually release these inventories to get your cash, you must ensure that they are completed. Okay, and the additional labor cost to make sure they are completed to the form which they can sell, you can sell, must be have to be invested to have to be available to do that, so that you can sell. I will give you an example. Like for example, you have an inventory and you intend to sell, and in the process of selling there's one problem. Okay, what kind of inventory will I use? Let's say, okay, let's say for example the uh let's say for the packaging, right? The packaging, the packaging of those products are not as good the way they used to be. You probably want to update the packaging and stuff like that. So, or they were never even packaged, so you have to package before you send. The additional cost this have to take, or the labor cost, specifically labor cost this has to take, must also be put in mind. Okay, to put to let this to reduce the inventory, to put them in the level at which they can be sold. Then we're going to look at how do we track inventory. So to track is that we must ensure to keep timely and accurate records of our inventory. this we this is very important in controlling the inventory cost. Okay, and the no matter the method used, there are different methods to control your inventory level and determine your order points. Okay, there are different levels to that. Okay, like the process will only work effectively if you keep accurate records of what inventory you have on hand, and the one and on order, the ones you have at hand now and the one that people have ordered. Okay, so you must adopt a good you must adopt a good method to control the inventory level. It's very very important. You also need to keep accurate track of the lead times of materials for production and inventory supply, so that you can avoid stock sales and overages. Also, by using one of the many available inventory control methods, you can minimize the amount of cash tied up in the inventory. You can have a tight inventory control, and in this will help reduce waste, obsolescence and spoilage. Okay, and by also managing inventory, you will be able to control costs. You are also overseeing your cash flow. When you manage the inventory well, overall you are managing your cash flow. Then we're going to look at receivables. Managing receivable to manage cash. Managing your accounts receivable to generate prompt payment is another way to conserve cash, to have cash. Okay, once you are in business that extends credit terms, this I already mentioned, to its customer, you will need to manage the timing of payments, and This is when I mentioned that you have to use the age schedule, and that you should always try to collect your receivable the better. Okay, the timely collection of your receivable is better for a cash flow perspective. So we're going to see uh, uh, receivables are what you expect and what you come in, the what is inflow into the business. I mean the cash inflow into the business. And if your inflows are not coming in the way they are supposed to, it actually affects the cash availability. So if you are not actively invoicing and collecting the monies owed, you can rapidly find yourself with too little cash to operate your business, and this will uh, this will also put you in a position where you don't have inventory, at the same time you don't have cash, because you've given out the product or service, but your customers has not given you the cash, and you will be at the losing end, at the disadvantage, because you don't have both, but your customer has the money and has the product. So we must ensure to always collect money and follow up on our customers, okay, in their debt. Their account receivable has a life cycle, just what do you call it, the operations has a life cycle. Okay, so the accounts receivable has a life cycle which will vary according to your type of business. This actually depends on what you are doing. So one tool that companies employ to manage their receivable is an ag schedule. Okay, this is this schedule helps to give you updates on payment due and payment not due, how many days this payment has been due, and the amount, the date, and everything. Usually there are softwares, there are some that are free and some you have to pay. They help track your collections and anticipate your cash flow. So ag schedule is an accounting table that shows a company's accounts receivables ordered by the due date. It can show if the customer is paying on time or not. Okay, this is usually how they look. Sometimes they could be more they could they this is just the basic way it looks. If you look at this, now, you would see that it has not due, and this is in discount. Okay, this is the discount column, and they have two people here. They have Adams. Okay, sorry, they have okay, they have Adams here. Okay, and they also have Zaniga and Adams. Their discounts will be like $120 and $480 they are supposed to pay. It's this is receivable for this company, but then it's not due. Then look at the second column. The second column has not due too. Okay, and but there is no discount, which is for sharers. Then we also have 50 days past due. We have for Adam Steel, okay, and say Chevron, and we have 30 days past due. Okay, this one is 15 days past due. See, it's 50 days. Okay, and this is 30 days past due. Okay, so 90 days and so on and so on. So this is how it basically looks if you use this ag schedule. When you just take a look at your screen or whatever device you're using, it gives you a summary of, it's just, life so made easy compared to before. You just look at the screen, you just know who and who. You see their names here, and their probably the transaction code, and we have all of these. Okay, so summarily you can see everyone at the same time. Okay, and you'll be able to know who and who has not paid, who is due, how much they owe, and the percentage too. So this is a lot easier to manage when you have this. Okay, there are many other software that you can use for this age schedule or for accounts receivables. So let's look at the life cycle of accounts receivables. Keeping these guidelines, like I already said, it will help to maintain a balance. With balance, it will establish care credit arrangement with customers that reflect acceptable terms for both of you. It will create comprehensive written credit and collection policies, which you can share with your team, and it will help you plan and implement rules and regulations that will benefit the business. Okay, then it's also appropriate to the level of delinquency. So it will also avoid using salespeople as collectors on their assigned accounts. Okay, then it will help comply with the Debt Collection Practices Act, and do not use intimidation, deception in collection. Okay, then recognize that some customers are worth firing as credit client. Just the way we fire our customer, you could also fire your just when we fire our staffs, okay, workers, people that are not doing their job diligently in a company or corporation. We could also, as a business person, you can also fire your customers, okay, as based on credit claim, because they are not credit worthy. I mean, because if you have that software like this, for example, you are using the aging schedule for accounts receivable, and every time it's always 15 days past, 30 days past, 60 days for this customer, and you see that the customer is giving you a lot of stress, the cost of following up on this customer is more than the benefit from the customer. You could actually fire that customer. So now let's look at factory. When we say factory, it means you could actually sell your debt. Yes, you sell your debt. Just the way you sell products and services, there are companies, their sole aim is to buy your debt. Okay, usually they bargain with you. When they bargain with you, they pay you the amount on agreement basis or percentage base. It could be on percentage or whatever arrangement the company has with you. They take this debt from you, and they pay you certain amount, and you just go. Then they will work on the debtors, and they collect their money. Most times they usually get it profits them. Okay, they are also companies. Their primary objective is to make profit, right? So probably they give you this, they pay you off probably 50% of the debt, and they follow up on the customer, and they collect on when they collect the debts, they get their money back, but this time around bigger than what they paid you. So you could sell your debts to these companies, or bodies that are actually they'll collect your customers that are indebted to you, and they do the job. Okay, you save yourself the stress. Okay, now when you factor receivables, you provide a list of the outstanding amounts and their status in an aging chart to the finance company, and they will offer you a percentage of each category of receivable in exchange for the right to those proceeds when collected. That is it. So we move to managing accounts payable to manage cash. This is credit. Okay, credit. Now we'll be talking about debtors, those that own us, and now let's look at those you own. Debtors are those that own you, right? They owe you your money, your business money. What about those you are owing? Okay, as a business, just where people are owing you, you are also owing others, because sometimes as a business you collect goods on credit to cover operation gaps. Okay, you wouldn't want to stop operation, you don't want to stop your business for running. It's normal, it's nothing wrong in using credit to run your business, it's fine. But then the problem is, how have you been paying? How do you pay? Okay, so just the way we have the aging schedule for the debtors, you could also use the aging schedule for these creditors, because when you have this software, just the way it has showed you here of who is owing and things like that, you could also be able to manage your own credit, and you also avoid a lot of inconveniences. Okay, because if you aren't managing your cash carefully, you could get caught in the squeeze between your suppliers and your customers. Okay, so we always ensure to strike a balance between your suppliers and your customers. Okay, you must try to have a cash flow that will be able to meet with the business management generally, managing your customers well and sweating your suppliers. Suppliers are very, very important, okay, because if your suppliers are not there, there's high tendency the business is going to fold up, business is going to wrap up. So once you have established a relationship with a supplier, he or she may be willing to extend credit. So that credit that they've extended must be met. On the due date, you have to pay. Okay. So you have multiple opportunities to negotiate too, okay, with your creditors, your suppliers, and you should be prepared to take advantage of them when they arise. I'm not saying you should cheat anyone, you don't cheat people, but then you should know when opportunity arise to negotiate. Okay, the leverage you have to negotiate will depend on the balance of power in the relationship. Then you must try to strike a balance. One of the reasons to give you an advantage over your supplier is when you are always paying on due date. So you could easily negotiate with them when it's due date, when you collect goods and they've given you and it's time to pay. You don't stress them out as a business person. You just pay them. They don't need to start sweating it out to get their money back. So it's easy to keep good relationship and bargaining power with them. When you do all of this, you meet up with dates with your agreement. They often new accounts have less favorable terms with vendors until they establish a solid track record. As you become an increasingly significant customers for your vendor, you can renegotiate prices including payment terms. Okay, sometimes you could ask for extension. Okay, but before you do this, you shouldn't wait till the money is due. Okay, you should only do this before that time. Negotiate with them and try to bargain well to favor your business. Now, I just talked about timing payables. Just as you should establish an account receivable aging schedule, you should also create an account payable aging. Means the account you receive. Okay, as you created the software that run the receivable accounts for you, let you know those that are owing you, the due dates, their name, the percentage, the amount. You should also run a payable account that tells you who you own, how much you own, the due date, okay, the percentage. Okay, all of this is helps strike a balance, and your cash flow will be able to, as you do this, you are managing your cash flow well. You are able to sustain the business, and you are able to grow the business well without facing cash flow shortage. Okay, when that happens, it's very detrimental to your business. Then we have capital budgeting and cash flow. Cash management is not only for operating cash and financing, it also includes the planning for capital assets. Okay, we've talked about cash. Now let's look at, we've talked about receivables, right? And we've also talked about payables. Now let's talk about assets, business assets. We have fixed assets or any assets. Okay, these are the purchase of machineries, equipments, and even their installation. All these, they are cost. Okay, you buy, you install, they are cost. Their business, they are cost. Okay, then and the like requires initial cash outflows for assets and incremental working capital for new projects. Now, capital budgeting will help you understand the cash flow required for investment and the expected impact on operating the cash flow. Now we're going to look at the burn rate. Okay, this is just the pace at which a company must spend capital before generating positive cash flows. It's not as if when you start a business immediately you start making profit. It's not magic. So because as a new business, there are a lot of growing stages. I remember last time in I think this semester, right, we did business life cycle, right? The life cycle of a business, how it starts, right? You have to the business has to grow. So most times it's not when you just start off you start making profits. So there are little delays, maybe for some months or a year. It's sometimes for a business to even break even, it can take up to like 5 years. So for this burn rate, is just that period when you've not started making profit, when the business, for the period when the business has started to the period when the business has not started making profit. Some business, when they start, initial stage, they make loss. Some, they might not make loss, but they are just making what they can use to cover the operating cost of the business. They are not making any extra income. They just make what they are spending, and over time you see the business will probably start making profit. But this varies with business to business. It varies from one business to another. Some might take months, some might take year. So that period is called burn rate. So this, it's when you start a business, it's actually normal to have a negative cash flow from operations for at least the first few months, okay? Because when a new company will probably spend more money than it earns. You spend more money than you earn, okay? You've not started enjoying the economies of scale, and you've not started enjoying that at all. So probably people don't even know that product yet, or your service yet. So all this come into play through may cause the reasons for not making profit for some months, or probably a year period, as the case may be. So but how can the business sustain itself? How long can this business sustain itself when they are not making this money, when you're making loss? How? The answer will depend on the amount of capital invested and the amount of revenue being earned. So you see the formulas there to actually for your perusal later. Then when considering cash and cash flow, it's also, let's look at the value of money, how it changes over time. There's this parable that says a bird in hand worth some millions in the bush. So it's so also for money. When it is important to evaluate the changing value of money over time, and that means a dollar today for available for investment is worth more than a dollar tomorrow. Yes, because tomorrow you don't know the rate of inflation, you don't know the value of money, you don't know. So a dollar at hand today is much worth than a dollar at hand tomorrow, because the one for tomorrow has not gotten to you, and we don't even know the economic factors that is going to affect the value of that money. So now you have the money is worth more than what you've not had. This it's just like this parable. They said what do you call it, a bird in hand worth millions in the bush, okay? So what you've gotten is what's more than what you've not gotten. So actually a cash can also grow as the money earned previously gathers interest. Yeah, because as you have that money, you can grow it, but the one you've not gotten, you cannot grow it. So this is why the money you have at hand now is worth more than the money you don't have now, that you're going to have tomorrow. So cash also, you can say cash can also grow as the money earned previously, as it gathers interest. Now we're going to look at the future value of money, okay? We've talked a lot today. We've talked about the importance of cash, okay? What we use cash for, okay? We've talked about income statement. We've talked about profits and cash, the difference, okay? We've talked about negative cash flow. We've talked about positive cash flow. We've talked about inventory, okay? And we've also talked about the operating cycle. We also talked about the ages schedule. We talked about receivable. We talked about payables. We've also talked about the value of money, okay? Value of money and how it changes over time. So now we're going to look at the future value of money, okay? There's a formula for that. If you look at your slide, you see that this is the form. Future value of money is present value. For you to get the future value of money, you must know the present value today, okay? Plus 1 plus the interest based on the number of years. This is the formula, okay? So I want you all to note this down and probably memorize it, okay? Now future value of money is the amount an asset will be worth a number of period from the present. Okay, so we also have compound interest. Okay, this is this is used with interest or rate of return and applied when earnings also accumulate interest or other returns in addition to earnings or principal. Then we have interest. Interest earning funds grows fastest in investment that offer a compound rate of return. Yeah, a compound rate of, that is those that are calculated on interest that has already accumulated over a period of time. So that is the formula you should know. And if you look at the effect of compound interest, you see the graph, right? See, at first year, this is it. Okay, the graph is easy. First year, second year, over the years it kept increasing. You see, 1000 at the first year. You see it now. At the second year, the 1000, or let's say at 2.5 years later, a 1000 today is worth 1000, let's see, 5, right? This is at 0%. So at the blue is at 20%. Okay, if you calculate it based on 20%. So if you look at the key, you see the blue color is 20%, the red, the dotted red is 10%, and the I think pink, right, that should be pink, it's 5%. So based on each percentage, the value of using the compound interest, the value of the money is changing over time based on the years. So the future amount of an asset or other investment is what at face value discounted back to the present. So this tells us that your money is worth more to you when it is in your hand. Like I already said, your money, the money at your hand now, what's more to you, that money you've kept somewhere that is not generating anything to you. It's not generating an asset. Okay, it's not used on anything, it's just locked out, it's not generating anything for you. So when prices, because the reasons are inflation. Inflation is always at play. All right, inflation is when prices rise. A dollar tomorrow will buy less than a dollar today. Okay, it does today. Like before now, the prices of things were quite cheaper, very very cheap. You could actually buy a lot of things using $1. But today, if you go out, you'll be surprised that $1 cannot buy you as much as it used to buy you. Okay, then another thing is the risk. You see, that money outside that is not in your hand is facing a lot of risk. So there's high tendency that it will not get to you. So this is why the money in your hand is worth more than that money that's outside. Okay, when you put money into an investment, there's always some risk of losing it, because business comes with risk. As far as that money is not in your hand, it's not right in your hand right away, whatever it's doing outside, it's facing a lot of risk which can take the money away from you, whether be it business or be locked in the account, or whatever thing that is outside is not in your hand. Okay, the opportunity, we have opportunity. So there are 3 reasons. These are the 3 reasons that the money, your money is more worth to you when it is in your hand. Is in your hand. These are the 3 reasons. The reasons that is inflation. Okay, inflation will eat up the money. Risk can eat up the money. The last one is opportunity. When you put money into an investment, you are giving up the opportunity to use it for what might be a better investment. Yeah, because for every decision we make, there's an opportunity cost. This I think you've done in your 100 level, right? We did opportunity cost, we did wants, we did needs. I remember taking those classes with the 100 level students then. Okay, so for every decision you've made, there's an opportunity cost. So if you have made the decision to put your money outside for one reason and it's not in your hand, that money also will come up with that decision you've made will have an opportunity cost. So there's that next thing you probably would have used the money to do that is better than that decision you've made at that point in time. So looking at that, we're going to look at the present value of money, okay, of $1 today in periods, in end periods. The end there can take any year. It could be 1 year, it could be 2 years, it could be 3 years, it could be 4 years, okay, it could be 10 years, 15 years. So when you use that formula, this formula is saying that this formula, the end year, this end year could be one, could be its number of years. The end actually represents the number of years. So look at this now. So for that place where you have n, you could put 1, you could put 2, okay. The periods, it could be years, 1, 2, 3, 4. It depends on what you are calculating for. If you are calculating for 1 year, you put 1 year. If you are calculating for 5 years, you put 5 years. So this is just applicable. It depends on what you're looking for. So future value for $1 today in n period in the future is what we have here. $1 in the future at 1% is $1, okay. What's that? 1.000, right? 1.0100. At 3% in 1 year, you see it, and at 10% in 1 year. If you move to the next column, it's at 1% in 2 years, at 3% in 2 years, at 5% in 2 years. When you calculate it, you get this, okay. Now we're going to, okay, for those of you that will probably find this difficult, this is the future. We are talking about the present value, right? Okay, you have this here. So you put you probably equate that. Where's the percentage? Okay, present value, you just key in the data you'll be given, you just key in into this formula. So we have the present value 1%, and we have this I, okay. The I is the interest rate. I told you the n is number of years, the I is interest rate, okay. So this you can try on your own and do some calculation, okay. So moving on, we're going to talk about taxes. Then another thing that affects cash flow is taxes. You know, the government, they don't joke with taxes. In short, taxes is one of the major income in which the government or any place you operate on, okay, you operate from, they make the government of that place, they make their income from. So if you are talking about cash flow, you don't plan on taxes too, you're probably going to have a lot of challenges with your regulators, okay, with the government of that place. So another factor that affects cash flow is for a business is taxes. So taxes should also be put in mind, okay. Like other creditors, tax levying body expect payment in a timely fashion. So you're supposed to make tax payment as an entrepreneur or as a business person or as a business manager. Ensure you follow up on your taxes, okay. And more importantly, tax payment must be kept current, okay, because usually if you don't pay on time, there is it can result in business closure and penalties. There could be personal penalties to the business owner, okay. Then we have different types of taxes in regards to cash flow. We have self-employment tax and we have sales tax, okay. For self-employment, these are federal tax that business owners are assessed on wages paid to themselves. The money you pay to yourself, the salary, you have to tax it. They are certain percentage, okay. These are regulated by the government, okay, and it varies from one country to another. It's not fixed, okay. Then we have sales tax. This is an assessment levied by government on purchases and collected by merchants. However, as an employer, you will collect and pay all your employment taxes to the appropriate government entities. Sometimes you don't you be the employer, the owner of the business, and you have employees, you collect the taxes from your employees, okay, and you pay to the government. So you must keep an appropriate data, records of those working with you, how much they earn, okay, so to ensure the payment of these taxes on time, okay. So for the case studies we are using for this course today, it's on the USA, okay. There's a website here, we have the US Internal Revenue Services by specific date each year, so you could as well take a look on this. But for like I already said, every country has its tax regulation. Okay, so it varies from one country to another, and it will be good, to be awesome if on your own, okay, for just for personal knowledge, you try to find out about the taxes, how this being regulated in where you are, or where you have your business. Just do it for doing sake, for knowledge sake. So moving on, we're going to okay, let's look at collective sales tax. If you sell products or service to the public, you will have to charge state tax, charge state sales tax in most states, and turn them over to the collected money monthly or quarterly to the proper agency. Some states only charge tax on products, some charge tax on products and services. Okay, some they don't charge on services. I'll give a good example. Some online business in some countries, they already charge taxes on them. When you do online business, you are made to pay tax. This is why sometimes when you register to some online market, like the eBay for example, or Lazada, or probably especially those from the US, when you register with them, they always ask you, do you reside in USA? If you say you reside in USA, they will open a tax account for you. But if you stay outside the USA, they know, and you don't need to pay the tax. But then this is why they tell you that some countries, some states anyway, some countries, some states, as the case may be, they tax on products, and some they don't tax on services, they only tax on products, while some they tax on both products and services. So we have tax issues for different legal structures. We have for sole proprietorship, we have for partnership, we have for limited partnership, we have for corporations, C corporation, we have for S corporations, and we have for limited liability. Then how do you make your tax easy to manage and pay so that you don't affect your cash flow? How do you do that? The first is that you must prepare good records. Okay, you and your tax preparer will have an easier time if you keep accurate records throughout the year. Your records should be accurate. Sometimes in some countries, when you start a new business, because they are supportive SMEs, small medium enterprises, they give you tax holiday. For the first months or few months when you start your operations, you are not made to pay. So you must ensure how the tax are being regulated, tax payment are being regulated in where you reside, because this will give you apart from the knowledge, also know probably if you want to do business whether you have a tax holiday or not. So then another thing is that you should, how do you well, first is be very conversant with the tax regulations of where you reside, okay, or where you operate from. Then you should keep proper accurate records throughout the year. Then the third one is that mistakes on your tax return, just the luck of the draw, could cause the IRS to audit you. No mistakes, no lying, no mistakes, because when you do that, you will be audited, and there's a big, in most countries there's big penalty for tax negligence. I mean, when you don't pay tax. In short, in some countries, especially in well, like the China for example, or Japan as the case for example, the penalty could even be life imprisonment. So this is why, as an entrepreneur, you must ensure you have you keep proper tax records, you know the rules regards the tax. Okay, also learn about the penalty if you should not meet up. Okay, then also you should also try to not make mistakes. Sometimes companies, corporations, they employ other companies. Okay, they just subcontract out to help them manage their tax affairs. Okay, most times law firms, they do this. They help you manage all your tax affair, and help you keep all your records. They follow up with it for you with the government or the bodies that are in charge. So that is all for today. If you have any question, don't hesitate to thank you.